podcast. Lovely to see you, Tim, and congratulations, because JEGI, as it's known, published its full year results this week for the year to March 26 and extended that market-beating run to 5 years.
Yep, thank you very much, Ian. Thanks for having us. It's it's been another good year, and always with these things, it's we want to talk about our performance. It's also good
Absolutely.
not to jinx anything. So
I'll hand over to you. I'll hand over to you and disappear now.
Great, no problem. Thanks, Ian. Thank you for the introduction, and good evening, everyone, and thank you for joining us to hear about JPMorgan Europe Growth and Income, or JEGI as it's known for short. So my name is Tim Lewis, and I am one of the portfolio managers on the trust, working alongside Alexander and Zaina, who you see pictured in this slide. And for those that haven't come across the trust before, I think it's probably best to begin with a sort of short introduction of JEGI and what we offer to shareholders. So ultimately, what we are trying to achieve from this portfolio is consistent, risk-controlled alpha generation from a diversified group of European companies, excluding those listed in the UK. So we want this to be a portfolio that's balanced, that can outperform in different market cycles and conditions, that isn't dependent on a certain sector or style to perform. So whether it's value or growth stocks that are leading the market, whether it's in cyclical moments or defensive moments, we want JEGI to perform throughout that period, and we think that's reflected in the performance chart you see here on the right-hand side, where really we have kind of experienced that changing in conditions, changing market leadership and different factors performing, and throughout that period we have shown consistent performance. To achieve this, we adopt a slightly differentiated investment approach, which we'll come on to, but it's merging both the quant resources that we have here and the fundamental insight that we have at our disposal too. And I think importantly to touch on here is, along with the consistent performance, the trust has put in place an enhanced income policy. So that is, we pay a 4% yield based off NAV at the start of the year. And the trust structure allows us, to pay first out of income, but it can also allow us to pay out of reserves and ultimately capital if required, meaning we can offer this level of income to investors without specifically having to limit our investment universe to just the highest yielding stocks. It's kind of, as we see it, investors gain that income without having to compromise on our stock selection. So really, if you're an investor who's looking to extrapolate a positive view on Europe, or you're just trying to diversify your portfolio globally, JEGI offers a real core exposure with demonstrable outperformance versus the benchmark. And I think if you were thinking about investing in Europe for the first time, or looking at it again for the first time in a while, you'd be in good company. This chart here shows how European, those opportunities in European equities are coming back on the radar of institutional peers. So for the first time in almost a decade, money is returning to the asset class. 66 billion of net flows into European equities in 2025 and 2026. And that's following a decade of outflows. And I think more importantly, these are trends that tend to last. And we believe we're just at the beginning of that cycle, supporting the asset class for some time. So why do we believe that is happening? Why is that interest warranted, and why can it continue? Well, number one, top down, we are seeing positive signals for Europe, macro tailwinds that are supportive of growth. Secondly, we think it's very important to be active in this period. So market volatility, emerging long-term themes are really shuffling the winners and losers. So the active management allows you to remain balanced through that, and also to exploit those opportunities for outperformance. And then third, there's just some really exciting themes and catalysts that are driving bottom-up company fundamentals, creating idiosyncratic opportunities for outperformance. That's really exciting for us as bottom-up managers within European equities. So to touch first on those macro tailwinds, and I think the headline's important because it's not just that we see a macro tailwinds into the future, it's the reversal of macro headwinds. Firstly, it's that fiscal stimulus impact in Europe is real and it's only just beginning. So set to boost growth this year, but also over the medium term, and we'll later explore some companies that we think are best placed to benefit from that. Secondly, I think European regulators and policymakers are finally waking up to the loss of competitiveness in the region. And I think efforts to remedy that are set to boost earnings and to generally just build higher quality companies. And then lastly, these tailwinds for earnings growth aren't being reflected in valuations. So the market's still trading in line with its long-term history, despite what we believe to be a much improved outlook. And then we think those factors are going to support Europe over the coming years, but it's not necessarily immediate. Nor is it necessarily in a straight line. And I think a combination of those speed bumps appearing and the history of Europe means there's understandable hesitancy by investors to really believe that Europe is turning a corner. And I think sometimes we get pushback on areas of geopolitical conflict or one thing or another. And I think it's important to always remember when investing anywhere, but especially in Europe, there is usually conflict in one part of the region or an upcoming election or political instability in some part. There's kind of always a reason to defer investing in Europe. But I think this chart helps to illustrate that geopolitical concerns are an almost ever present, and performance has been achieved despite this. So this shows the trust NAV in purple over the past 5 years through what has been a volatile macro environment and still achieving strong returns in an absolute sense, and then also relative to our benchmark in yellow. And importantly for us, that is outperformance that has been achieved consistently and in a stable manner despite that volatile macro and market environment. And we also like to point out, that consistency of returns has allowed us to outperform the S&P 500 over the same period, which you see here in blue. So let's now switch to talking about the trust, our investment philosophy, and our process. So first of all, we want to invest in quality companies. And by that, we mean companies that generate good and sustainable returns on invested capital, companies where the earnings per share translates into free cash flow. We want to invest behind management teams that we think are making sensible capital allocation decisions. And through all that, we're looking to assess the duration of those attributes. How resilient is their business model? How resilient is that market opportunity? In terms of valuation, it's really important for us to work out when the market has already discounted these prospects, or if there's still an opportunity to make money. Because I think it's really quite easy to identify the best quality companies in Europe, and that strategy wouldn't have worked well over the past number of years. What we need to find is, where we have differentiated insight. Where is our research pointing us to ideas, whether it be companies or themes, that the market is incorrectly priced, so that where there's a higher quality than the market is pricing in, where the outlook is better than the market is currently pricing in. So I think it's being very disciplined to that valuation approach. And then finally, we invest behind companies that are already performing well. And when we think about that, we're looking at both the operational momentum of the business and the share price momentum of the business. Because in our experience, companies that are improving often continue to improve for a period of time, and then the opposite is also true. As you'd expect, we are supported by the broader resources that we have here at JPMorgan. And I think that's incredibly vital to us, from our global sector specialist analyst teams who are on the ground in local markets, helping to build a global view of sectors, even though we are just investing in Europe, to also then the technology that we use that helps us make better informed decisions where we can leverage the overall tech spend coming from the whole business. And we think the combination of both those quantitative and fundamental analysis is really key to what we do. So those quantitative tools on the left-hand side allow us to assess over 1,000 companies daily in a rigorous and repeatable way. And it helps us to screen for companies that might require follow-up work, follow-up fundamental work. And it also, I think very importantly and sometimes missed out, it's to assess our existing holdings in an unemotional and an unbiased way. So it really adds discipline to our decision making, and I think supports the idea that our process and by virtue of that, our performance is repeatable. Then on the right-hand side, we have the fundamental research, and that's done at both the analyst level and the portfolio manager level, which allows us to dig deeper, allows us to be more forward-looking and context-aware. I think it's better really at understanding the why behind the numbers, especially where the data is less clear-cut. So, it helps us to recognize changing business models and to assess one-off or binary risks. For example, if we're seeing in a pharma company an upcoming drug trial or a large blockbuster drug that is coming off patent. And ultimately, we then need to bring these ideas together to form a portfolio which balances our stock insight on the one hand with appropriate risk management on the other. And here we combine proprietary and external tools to view our portfolio from multiple perspectives. That helps us to manage macro exposures, run scenario analysis, and really have a deep understanding of our portfolio. And it's important to recognize when we're talking about this, when we think about managing risk, it's always with the mindset that we want to control our incidental risk so that we can take risk where we believe we really have an edge. That's investing behind companies with those characteristics, with that disciplined approach to allow us to achieve consistent performance. And ultimately not be blown away by a macro event that we hadn't realized we were positioned for or against. And I think we won't dwell on this slide. As I mentioned with Ian, we're very happy with our numbers, but I think more than anything, it shows how that disciplined investment approach is kind of evidence in the performance we have that's generated consistently over the past decade and longer. Often in these sort of presentations, we switch to kind of what's been working for us and what hasn't. And I think here we've taken the past 12 months to the end of April. And what's interesting here is what we see on the left-hand side is where has our performance come from sectors. And as shown in our sort of portfolio construction, we keep our sector actives relatively tight. So we'd expect most of our performance to be driven by stock selection, the yellow bars here, as we see. And so that's consistent with what we would typically see every year. What's slightly different this year is then often when we present, and I'm speaking about what's on the right-hand side, talking about the companies, which is really what people want to hear about, often we're reflecting on the heterogeneous nature of these companies. So the companies coming from different sectors, very different bottom-up drivers, some that have worked for us, some that haven't, but all very different stories. I think this year, it's actually been quite different. The market has been so dominated by a couple of themes, well, really one theme, but let's give credit for two or three. And here, if I look down the list, I'm primarily thinking about the huge boom in AI CapEx spend, whether that be in data center demand with ABB or cabling with Prysmian, in overall power demand with ENGIE and Siemens Energy, and similarly, not owning Nokia, and then also the closure of the Strait of Hormuz, which is the other big impact, which we see with SBM Offshore or sometimes in the bottom names with ENI as well. So I think again, I think it speaks to well-controlled risk control to limit the underperformance, but still achieving stock selection on the upside, but a slightly different year than we would usually see. But in the interest of time, I think it's good to switch to look forward and where do we see opportunities. I think I mentioned the improving fiscal landscape in Europe, and I think many of you will already be aware of the significant change that came more than 12 months ago. In that regard, particularly from Germany. And I think that's very meaningful from a regional perspective. The largest economy with the broadest shoulders in terms of their debt position, signaling a far more supportive fiscal stance. And you'll see from the chart on the left-hand side that this was badly needed. So here we show government investment over the past 2 decades, where we strip out the extraordinary periods around the global financial crisis and COVID. So it's really the underlying fiscal support for the regions. And you'll see that really Europe has trailed US in that regard. But that is set to change. In fact, it's already started to change. And we believe the respective balance sheets, the signaling that we're seeing from politicians support this continuing for the rest of this decade at least. So when we think about who are the beneficiaries of this, for 2 decades, Europe has systematically underspent on defense, relying heavily on the US security umbrella, continually missing its NATO commitments. And that era is clearly over. So the Rearm Europe plan aims to increase spending in defense by 800 billion through to 2030. And crucially, that surge in spending is designed to favor European manufacturers with the desire to rebuild the industry in the name of strategic autonomy. So the first name there, Thales, is a French company that makes the technology layer really of modern defense. Radar systems that watch the skies, communication systems for soldiers, cybersecurity for governments. So it doesn't make tanks and fighter jets, but it is more modern tech equipment that is needed for modern warfare. And contracts signed today become revenues for years to come. So we're closely monitoring order books, which, at the most recent earnings grew 27% year on year, driven by large contracts coming from European governments. ABB, the stock underneath that, is a Swiss industrial that makes the equipment that keeps electricity flowing. So this is circuit breakers, switch gears, grid automation systems, all this power distribution technology that sits between a grid and whatever needs powering. So when we, anything that is needed for Europe's reindustrialization push. So every upgraded port, every new factory, every new data center, none of that works without getting reliable power to it. And that's where ABB sits. And I think company frames its own opportunity very simply, saying the world needs more power and that infrastructure to deliver that hasn't kept pace. And that's the real opportunity for ABB. This slide, I sometimes get given out to for this chart on the left-hand side, but and I know I'm running short on time, but if you please allow me a few more minutes. This shows what I think is one of the most remarkable capital expenditure curves in modern corporate history, because this is the annual infrastructure spend of global hyperscalers. So names like Amazon, Meta, Google, Microsoft. And what it's showing you here is how those estimates have changed over time. And so I think what's easier to do is look at 2 lines. So the purple line at the bottom is the estimates from 2023. So that's telling us back at the start in 2021, the market believed these companies would spend around 120 billion in capex. And ultimately that was pretty accurate, coming out at around $150 billion. But what we're seeing now is a rapid acceleration in spend that wasn't anticipated in the market and is really beyond anything we would have believed possible. So take, for example, the orange line, which is this year. 2 years ago, the market expected that to come in around $250 billion. That number is now $650 billion and continues to grow. And I think the critical insight to take from this is to benefit from this AI boom, you don't need to own one of those hyperscalers. In fact, often the smarter play is to own the companies providing the essential tools, the equipment that are making that build out possible. They're the kind of picks and shovels, as we have in the title of the AI capex boom. And here on the right-hand side, we have 2 of them. I think ASML is probably very well known to the audience, but it should be reiterated that this is a company with a monopoly in the leading edge lithography equipment that is needed to pretty much produce every single AI chip that will be made. And so none of this is possible without ASML. It's in a hugely influential position throughout this. Legrand is one slightly less well known at the less glamorous end, but what they do is the physical infrastructure that keeps data centers running. The things are racks that hold the servers, units that distribute power to them, the systems that stop them from overheating. So not nearly as glamorous, but still very important. And it's where data centers have been growing at 20% a year for that business, not just from the increase in data centers, but also having more demanding ones. And so just to conclude very quickly, I think we strongly believe the opportunity in Europe is growing stronger. It is not necessarily a straight line, and it won't be, it isn't without bumps in the road. But it's very important to look through that and to see the historic performance that has been achieved and the turning points that we are seeing in Europe. And we believe JEGI to be an ideal core holding to help you get that, offering a differentiated investment approach, demonstrable outperformance versus the benchmark, and that attractive income as well. So with that, I'll hand back to you, Ian.
Thank you very much. That was absolutely great, and you'll be delighted to know we've got plenty of questions coming. So have a quick, as I say, quick hydration break. And John in Southampton has said, given your focus on attractive valuations, how long do you run your winners if valuations become extended? Could you tell us a little bit about your sell discipline?
Yeah, so I suppose the first thing to say is that when we talk about having, what we're looking for in companies, what we will always have is a positive tilt versus the benchmark to those metrics. So quality, value, and momentum, for example. Doesn't mean that every stock that we hold will be cheaper than the market, but rather on aggregate, our portfolio will always be cheaper than the market. And when it comes to that, we are very willing to run companies that are performing well, and that's part of the momentum that we're looking at. But we also need to be cognizant of when we believe market valuation and market expectations are both reaching kind of peak levels. For example, we would have seen that in European defense names, where we felt like sell-side revisions were already gaining so much to try to justify the valuations that were always there. Mm-hmm. So we would look at that situation very differently to, say, ABB, which I've talked about there, which is an expensive name, on a 1 year forward multiple, but where we're seeing revisions still being revised upwards, and where we think that higher multiple is now reflecting the higher organic growth that we see for the next 4 or 5 years.
Interesting, very interesting. Another one actually on valuation, but it's more about the European market. Gurmit has asked, European stocks have always traded at a discount to US stocks. Can Europe re-rate, and what will drive that?
Yes, so European, I sometimes say, the day that I tell you that Europe will trade at on par with the US or the premium, you can cut me off. But that doesn't, so Europe will always, not always, because historically they have traded at a premium, but our expectation is that Europe will continue to trade at a discount to the US. But that doesn't mean that discount can't narrow, because what we have seen is, we try to cut through this in a number of ways. We look at it at a market level, and we see that discount extending. We look at it and we think it could just be the sector composition. But when we look at it in a sector neutral way, we also see that wider in all but one sector, I think, which is tech, ironically, but we are wider than we have been over the past 25 years. So I think our argument isn't that Europe will reach the levels of the US, but rather that discount will narrow. And I think the reasons that can happen is the reasons put forward, is that the kind of fiscal support is potentially switching, will be more favorable to Europe. And we think that, a more diversified market is really going to help Europe in the coming years. And we see that in areas like banks that have already been, working for quite a long time now.
Yeah, you've mentioned the picks and shovels. Charles in Tunbridge Wells has asked, are there any new and exciting themes you've introduced to the portfolio? Or does that already cover it, anything?
Yeah, I mean, I think there's always new themes coming through, and indeed themes that we were excited about that leave. And while we're not a huge high turnover, we are happy to embrace these. I think areas that we have seen is infrastructure spend in Europe. So this is, when I say new, 12 months theme. But and what's been surprising to, I think, a number of investors is that, when the headlines are, well, actually Germany haven't been spending what we expected them to spend, or whether that hasn't really been coming through, we've actually found a number of the more engineering focused names, engineering consultants and small cap names like Bilfinger and SPIE performing very well, partly because of a tightness in their market, which was allowing them to have pricing power. So I think, fiscal infrastructure spend is coming through. Energy transition, I think, has been one, not particularly new, but is growing. And then I think that AI CapEx spend, but I think the important thing is it's quite a broad one. So it includes like utilities, because of our grid infrastructure needing to be enhanced. It includes, some of the obvious semis named, but it also includes some of the industrials, cabling, and I think we've picked up lots of opportunities there.
Yeah. Now, a final question, and actually it's one I wanted to ask, because I was going through wrote up the 2026 results, and one of the things that really impressed me is your style. You guys don't reach for returns or ideas. A lot of managers that we talk about hidden gems, but some of your best performers were things you mentioned: ABB, big Swiss industrial. I noticed ENGIE, the French utility, was a good performer. KPN, the Dutch telecom. Novartis, big Swiss, pharmaceutical. These aren't hidden gems. These are very big, very well known, European large caps working in big liquid markets. And almost, to me, they're kind of what traditionally we might have called value names rather than income and growth. So I'm really fascinated as to what in the process or within Spectrum kind of points you at these names when other people don't. They're almost hiding in plain sight.
I think it's a really good point, and I think you're right. They're not hidden gem, but they're still overlooked.
Yeah.
And I think one of the things is some of those names. In fact, I think quite a few of them, ENGIE, Novartis, maybe not ABB to the same extent, but some of these are stocks that other portfolio managers maybe have more scar tissue around. And I think that one of the areas that's really great for us, and then if we look back over 5 years, I think European banks have been a huge contributor to our overall performance. And one of the, by having this unemotional and disciplined look at our portfolio through our approach, it helps us to look at stocks that we like and have great companies that have been performing really well and really give us a kick when some of that valuation starts to look extreme, or the momentum starts to be shifting on it, or the quality doesn't look as attractive as it used to. But it also gives you a nudge to look at Orange or ENGIE or these companies that you're very comfortable not investing in, right? Nobody gives out to you if you never touch them because history has told you not to. And that's what worked for us in European banks, where we could see the capital positions had completely changed. The capital discipline had completely changed when they were talking about share buybacks. And then the macro had changed. So the momentum is coming behind them, new interest rate environment. And you put all that together, and they're sort of unloved names. So they're not unknown, but they're unloved.
Yeah. Well, that's absolutely brilliant. Thank you, Tim. I think